When we listen to the word like trading and investing, basically at the beginner stage we will get wonder because see, at the core level it is all about buying and selling a share. What's the major difference between this? No, there is a big difference between being as an investor and a trader. Not just that, there are particular steps that need to be taken care of. By keeping this in mind, we are trying to make this video to let you know what are all the steps that needs to be taken care of to get started with trading. By the end of this session, you will have a complete clarity of step-by-step clarity of what things needs to be taken care of and what are the cautions that needs to be taken care of, what is the risk involved in trading, and also how you can get started with trading from the scratch. Hi, my name is Nataraj Malavade. Welcome back to yet another interesting video from Trading with Groww YouTube channel. Let's get started. First thing first, the fundamentals of the trading. What exactly trading? Trading is all about a transaction. Transaction between two parties who have the different opinions. Let me simplify it for you. Here is my mobile. This is my mobile and I want to sell it for 1000 rupees. At opposite to me, someone has to be there who is ready to buy my phone at the 1000 rupees. Of course, I'm not going to sell my phone for 1000 rupees, but for an example sake, I'm taking this example. When the opposite party also agrees to buy my phone at 1000 rupees, then the deal happens. The deal or the transaction is called as a trade. So by using this mechanism, if you can speculate the financial markets, then we can call it as a trading, or the entire process of buying and selling a goods or services between two parties who have a different opinions of the same service and products is called a trading. Then you might ask, now what is the major difference between this? So basically people say investing and trading, it's all about buying and selling a share, right? No, the major difference between being an investor or a trader or the investing and trading is the holding time. So how much time you are going to be with that particular transaction is what differentiates the investor and the trader. For example, when you are into investing, basically I'm talking about a value investing. So people or the investor look for a company which are fundamentally performing good, basically like economical modes or balance sheet, cash flow or income statement. So basically fundamental part of the business so that they can stay with that business for a longer term and build wealth with that business. But when it comes to the trading, it's completely different. Basically trading or speculating, it's also called as a speculating. People look for a very short-term view on the market. So basically they want to get benefit from the short-term movements of the market. And next major difference is basically the approach. So investors takes an approach of fundamental analysis where, as I said, he looks at the economical modes and he compares peer-to-peer comparison between certain financial metrics. All those stuffs comes at the level of investing. But when it comes to trading, it's all about technical analysis. Most of the traders relies on the technical analysis part. So as in like candlestick charts or price action analysis, volume analysis, there are so many areas, basically trading indicators, all those stuffs. So he tried to time the market. Well, in value investors or the investor tried to invest in the business. This is a major difference between being an investor and the trader. Now you might ask, okay sir, I got the idea of what is investing, what is trading, what exactly trading is all about, but now how can I get started? So this is where the first step comes into the picture, which is having a demat and trading account. Of course there is a big difference between demat and trading account as well. I will let you know that. So you need to have a trading and demat account in the first place. So how can you do that? By approaching the broker or the depository participant who is authorized by Securities Exchange Board of India, which is a central authority who are controlling stock market, financial markets, complete Indian financial markets. So what is the difference between trading and demat account? Demat account is basically the account which holds the shares or the any financial instrument in the form of electronic form, but wherein trading account holds the cash or the margin of an investor to transact. So in suppose let's say you are trying to invest in some company, that means you are buying that company. Initially the margin will be deducted from your trading account, and after that, instead of that margin, you will get the shares in the electronic form, and that will be stored in the demat account. So who can help you? So broker or the depository participant will help you to open a trading and demat account. Now comes the important part which needs to be taken care, but most of the people neglect, which is inherent risk involved in the trading. Understanding the inherent risk is absolutely critical in that when it especially comes to the investing, because see when you are an investor, then you are looking for a long-term thing. So basically when you are giving a lot of time for market, the chances of you be in the winning stage is quite high when you are investing for a longer duration. But investing is all about a short-term duration or the short-term speculation. In that particular perspective, there will be a substantial risk which you need to understand. In that, the first risk that you need to understand is the uncertainty. Most of the people think, or especially after the COVID era, so most of the people are thinking trading can be a regular income. So if you're looking for a regular income by the trading, absolutely it's a big no, because you can generate an irregular income from the trading, not the regular income. There is a big difference, right? So over the long period of time, by playing the odds or by betting on the odds of the overall whatever you are doing, like technical analysis or everything, so that will work as a probabilities. That is not a certainty. So if you are looking for a certainty income, definitely trading is not for you. There will be an uncertainty, because as it's as simple as that, if you give more time for the markets, it will reduce the volatility risk. But if you are looking for a very short duration and within that particular duration you want to create an income, then it will definitely come with a risk, which is volatility risk. So that is the initial risk that you need to be taken care of. You should not be depending upon your monthly bill payments. All those stuff should not be linked with your trading income. Trading income, yes, you can generate the income, but it is not a regular income. It is an irregular income, inconsistent income over the long period of time. By trading more number of trades, definitely you can be a winning trader, but definitely it is not a consistent regular income. It is an income, but inconsistent or irregular income. Risk number 2, which is taking tips or taking advice from someone else. When you want to become a better trader, or when you want to be the best investor, the first and most important quality of any particular best investor or the trader is to be an independent decision maker. You have to take the decisions independently. Of course, in the initial stage you need to learn all those things, but later on you have to be an independent decision maker, which is absolutely critical. You should not be depending on someone else. Someone said like, sir, buy this, or this is a target, this is a stop loss. No, you should not be depending on those kind of tips. You have to take your own decisions. This is also one of the critical part. Risk number 3, liquidity risk. When you are looking into trade, so basically that instrument should contain more people, or basically it should contain more volume, so that you can get in and get out of it without any issues. So this is one of the major issue. Most of the people don't look into the liquidation or liquidity part of that particular instrument that they are trading. This is also one of the critical step that you need to be taken care of. So when you are in the beginner stage, it is absolutely suggested or recommended to trade the large cap stocks. So basically the stocks that have more liquidity or more volume, especially like Nifty and Bank Nifty also is fine when you are looking to trade a future and option. So Nifty and Bank Nifty are the better option. So I just said future and option. Broadly, there are so many classifications or the asset classes that you can trade, like equity market, future and option, commodities, currencies. Different markets are there, but most of the people stick to like equity and future and option. So let me give a brief simple idea of what exactly these are. So equity trading or direct stock trading, so like selecting few or more stocks which have more liquidity and which have more beta or high beta stocks. So you can search this term in the Google, you will get to know what is a high beta stock. So basically having more volatility stocks comparing to the index. So high beta stocks, and of course the high liquid stocks, so that will be traded by the traders. So that is one part, which is like equity trading. And in the second part, we have a future and option. Most of the people utilize the benefit of margin requirement, and with less margin, so they trade bigger instruments like Nifty and Bank Nifty, and also the direct future, which are the derivative of the equity. So basically there is a Nifty 50, right? So Nifty 50 is a direct index, but there is also a Nifty 50 derivative in the form of future and in the form of option, so which derives its value from the Nifty 50. So don't worry about it regarding the future and options and also option strategies. There are so many ideas or so many aspects of the trading, so that will be covered in our channel. Stay tuned. So basically like people trade future and option and equity, so majorly. And also there are certain asset classes like currencies and commodities also will be traded, but according to the present market scenario, most of the people stick to trading either equity or future and options. Well, then comes the next important point, which is different types of trader. Like within the traders community, there are different traders or different types of traders based on their approach. So basically the first one is a day trader or intraday trader. So as the name implies, his time frame or the duration of his trades will limit within the day itself. So that means he is buying some shares, so that will be closed within the day itself. And second type of trader is a swing trader. So basically he trade or his time duration will last for like, let's say, 1 week or more than 1 day, of course more than 1 day, to within 1 month, something like that. And after that also there is a different type of trader who is a positional trader, just near to the investor, but basically he times the market more than 1 month. He holds his trades, and like let's say I'm buying today some shares, and after 1 month or 2 months I will sell it. So this is basically the positional trader or positional trading. So based on the approach of a trader, the trading can also be classified. Like if he is an intraday trading or if he's into intraday trader, then we can call it as an intraday or a day trading. Then If it is more than one day, then we can call it as a swing trading. Basically, he tried to capture the momentum of the market or the short term momentum of the market in the form of swings. And then there is a different classification which is positional trader. So basically, he looks for trades which are more than like 1 month, 2 month, 3 month. He hold this particular trades. Basically, the major difference between all of this style of trading is the time duration with which they hold the trades. Well, now come the major question of a trading community, which is how to trade the market. So basically, on what basis we should be trading? Like as I said, for an investor, all it takes is like fundamental analysis, comparison of the companies within one company to another company, the financial metrics and financial balance sheet, economical sheets, economical mode. All those stuffs comes when you are looking to invest in a company for a long term. But trading is completely different. As I said, most of the traders rely on technical analysis. So in the form of price action, in the form of indicator. That's it. So there are two important classifications in the technical analysis. First one is the indicators, which is again derivative of the price action itself. And second portion of or second part of it is price action. There will be people who will trade the markets just based on the indicators, like famous indicators like RSI, relative strength index, ADX, and MACD, MACD, and stochastics. So basically, there are many instruments or many indicators by using that market can be timed or market can be traded. So people use it, one or two indicators, and they make a system out of it, and they enter and exit markets based on the information given by the indicators. And other side, the price action part comes in. So basically, price action is all about understanding the behavior of the price and the repetitive pattern of the price. So the trader just looks into the repetitive pattern of the markets based on the past data of the price, and obviously he anticipate or he try to anticipate the market with respect to the past behavior of the price in the form of patterns, in the form of some like triangle breakouts or like trend breakouts, all those stuff. So trend line breakouts and basically the candlestick patterns, all those stuffs comes in the part of price action. Last but not the least, most of the people are asking me, Nataraj, can I leave my job and start my trading, or can I leave my this consistent income job or the business and can I start trading? Definitely big no, because as I said, the fundamental part of the trading is that it is an income, but it is not a regular income, or it is not a consistent income. It is an inconsistent income. So that you need to be taken care of. And obviously, trading works for a long period of trade. So you need to be there. You need to manage the risk. You need to manage the money. All those things comes in the first place. And after that, learning about the trading is absolutely critical in the first place. And after that, you can take the decision. So I have listed few checklists. So if you pass this checklist, then you are eligible to take the trading as a full-time trading, or like full on to the trading. So first thing is, you should not be having any debt, or you should not be having any loans in form of like it may be for home loan or something like that. Zero debt is absolutely critical. And second important thing, you should be profitable at least for 1 year. At least for 1 year you should be profitable, not by one or two trades, no, at least 100 trades or like 200 trades. After that, you should be profitable. So this is also one of the checklist. And most importantly, trading amount or the margin that you maintain for trading has to be separate after your backup amount of, let's say, 2 or 3 years. So at least 2 years you need to be prepared. Whatever the lifestyle that you are leading today, that lifestyle should not be disturbed at any given cost. So that amount you have to keep it separately. We can also call it as an emergency fund, so that you have to keep it separately for your survival. And after that, whatever the money remains, that you should be using for trading. So which is also one of the critical step. Well, this video was all about understanding the beginner part or beginner stage, which are all the things that matters the most when it comes to trading. But similar to this, we are going to upload many interesting videos on trading. Like if you have any particular thoughts or particular doubts, so please let us know in the comments. Most importantly, if you don't want to miss those updates in the future, kindly consider subscribing to the channel, and also click on the bell icon and enable all notification to get the immediate notification from our end when we upload a new video. I hope you like the information that I've shared so far. If so, why not to like this video and share this video with those who are interested in the beginner part of the trading. The information that I shared so far is for educational purpose only. It is not any buy or sell recommendation. Before taking any particular decision, especially trading contains a lot of risk. By keeping that in mind, you need to take a decisions, responsible decisions and independent decisions, because stock market investments are absolutely subject to market risk. Said that, I want to end this video now. See you in the next video. Until then, take care. Bye bye. Jai Hind.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.